So, what are bonds? They're forms of debt issued as securities with the ability to trade in the marketplaces similar to stocks. Unlike stocks, bonds don't offer equity ownership rights. They represent a loan from the buyer to the issuer of the bonds. Bonds can be issued by companies or governments and generally pay a stated interest rate. The market value of bond changes over time as it becomes more or less attractive to the potential buyers. Let's look at different reasons why investors purchase bonds. They do this to help provide capital to corporations and governments that need it, or to receive a stream of semi annual income at a known rate. They can also do it to receive the original investment amount that's paid back by a given date. When you're buying a bond, you are giving the issuer a loan with a periodic interest payment along the way. These are usually distributed twice a year. Next, I'll go over bond markets and bond life cycles. Bonds are originated in the primary market through a bond issuance process that offers the issue to the public for the first time. During this process, issuers receive capital and in return provide investors with bond certificates that outline the issuer's obligations. Once the bonds are issued and in circulation, they're traded among investors and dealers in the secondary market. At the maturity date, bondholders receive a final coupon payment and are repaid the principal amount. Issuers have the opportunity to refinance the debt obligations through the issuance of new bonds in their primary market. These are some bond terms to know. Coupon. This is the interest rate paid by the bond. In most cases, it won't change after a bond is issued. Yield. This is a measure of interest that takes into account the bond's fluctuating change in value. Face value. This is the amount the bond is worth when it's issued, also known as par value. Price, the amount the bond would currently cost in the market. Maturity, period during which its owner will receive interest payments on the investment. Rating, a grade given to the bonds that indicates their credit quality. Let's take a deeper look into bond yield versus coupon rate. The term yield refers to the earnings generated and received on an investment during a specific time period. Yield is a return measure for an investment over a set period of time, expressed as a percentage. Higher yields are perceived to be an indicator of lower risk and higher income. Coupon rate is just a stated rate of interest the bond issuer agrees to pay the investor. You may or may not have heard the term yield curve before. Now I'll help you understand what it is. The yield curve is a visual representation of how much it costs to borrow money for different periods of time. It shows the interest rates on US Treasury debt at different maturities at a given point in time. So on the y-axis, you can see the yields being higher going upwards. On the x-axis, you can see the years to bond maturity. Under normal economic conditions, the yield curve tends upwards, indicating that you earn lower yield on your bonds short-term than long-term. An inverted yield curve happens when you earn higher yields on short-term bonds than long-term bonds. An inverted yield curve has proven in the past to be a reliable indicator of recession. There are two different types of bonds: bonds issued by companies and bonds issued by governments. Companies can issue bonds, but most bonds are issued by governments. Governments are generally stable and can raise taxes if needed to cover debt payments. These bonds are typically higher quality, although there are exceptions. Let's look at US Treasury instruments. Treasury bills don't pay interest, instead they're issued at a discount, and they have maturities up till a year. Treasury notes have maturities between 2 to 10 years. Treasury bonds have maturities of more than 10 years, most commonly 30 years. Treasury inflation-protected securities have return that fluctuates with inflation, meaning higher inflation is equal to higher return. You'll have to pay federal income tax on interest from these bonds, but the interest is generally exempt from tax. Because they're so safe, yields are generally the lowest available, and payments may not keep pace with inflation. Government agency bonds. Some agencies of the US government can issue bonds as well as including housing-related agencies, like the Government National Mortgage Association. Most agency bonds are taxable at the federal and state level. Municipal bonds. These are bonds also called munis or muni bonds. They're issued by states or other municipalities. They're generally safe because the issuer has the ability to raise money through taxes. Municipal bonds is a fixed income debt security issued by a government entity to fund public projects like construction of roads or sewer systems. Corporate bonds. These bonds are issued by companies. Interest from these bonds is taxable at both federal and state levels. Because these bonds aren't quite as safe as government bonds, the yields are generally higher. Corporate bonds are issued by a corporation and then sold to investors in exchange for cash. Next, I'm going to go over alternative investments. There are a bunch of other investment alternatives to stocks, bonds, and funds. Some of them include precious metals like silver and gold, commodities like raw materials or primary agriculture products, real estate like housing or rental property, collectibles, for example, art, or crypto, digital currencies. Owning precious metals may be part of a diversified investment portfolio. Gold may be seen as a hedge against inflation and a store of value. A commodity is a good that's interchangeable with the same good from another producer. For example, wheat, oil, beef, and coffee are commodities. For example, wheat, oil, beef, and coffee. Most commodities are traded through a futures contract, a promise to buy or sell a certain amount of commodity at a special price on a certain date. Real estate investment trusts allows you to invest in real estate without the physical real estate, basically dividend paying stocks. Owning rental properties can be a great opportunity for individuals who have the do it yourself renovation skills and the patience to manage tenants. Real estate investment groups are like small mutual funds that invest in rental properties. A collectible can be a physical object that people can collect, from trading cards to vintage cards and everything in between. Collectible investments are defined as real assets that are worth more now than when they were originally purchased. Cryptocurrencies are digital currencies. Cryptocurrencies are sold and transferred through an online ledger known as a blockchain, a distributed peer to peer network. Blockchain technology offers key benefits such as accuracy, transparency, and speed. An example is Bitcoin. Here you can see how the price of Bitcoin have fluctuated over time.